Hey everybody, hope everyone's doing well and had a good day. This is the Emini review for Thursday, June 20th, 2024. And because it's Thursday, we're going to look at the weekly chart first. Tomorrow is Friday, weekly support and resistance will be important. And you can see the market has been in a tight bull channel for several months. And here, strong rally, pullback, second leg. And now I have a couple of problems with the rally right now for the bulls. So we'll start with this. It is a 4-bar micro channel, and that's good for the bulls. Every bar since here, the low of the bar is at or above the low of the prior bar. So we have trending lows, trending closes. Bars are closing above the highs of the prior bars. That's all good, at least for now here. Again, we still have Friday tomorrow. One of the problems I have is that it's 2 legs up. 1, pullback, 2. And the market is accelerating. You can see if you look at the moving average, a little more flat. Not that it's flat, it's obviously sloped up, but look at the acceleration. That's climactic behavior. And that doesn't necessarily mean the market's going to reverse, but I do suspect we'll have a pullback fairly soon. You think about it. Who's buying up here? You know it's not value bulls, because the moving average is one measure of an average or fair price. And so up here, the market's expensive. This is value. So traders buying up here know they're buying expensive. So who's buying up here? It's momentum bulls. And eventually, the momentum is going to slow down. And when it does, everybody's going to stop buying. Bulls who bought down here are going to take profits. You combine that with momentum bulls stop buying. Plus you have bears betting 2 legs up, climactic behavior. Maybe they start selling. We're far above the average price. These are all the things that contribute to the start of the pullback. And then one more thing about this chart while I have it pulled up. As I mentioned, tomorrow's Friday. The market often tries to do something for at least a weekly chart on Friday to drastically change the appearance of the bar. And the market either wants to close near the high or the low of the bar, if it's near either of the two. In this case, we're around the midpoint. So for now, the bears are hoping they can close below the midpoint of the bar and at least claim that they control the bar. Even if it's a bull body, the bears can say, we have a bigger tail on top. That is if we get below the red line, the midpoint of the bar. And that would damage the bull case. It would still be a bad low one short, tight bull channel, micro channel. It would be a weak signal bar, probably buyers below. The first reversal down will probably be minor, but it would at least start to damage the bull case. And with that said, we look at the daily chart. And I don't remember if I said this in my prior video, but coming into the day, you notice that, let me see if I can just, oh well. You notice that the follow-through bar, so we had a bull breakout, follow-through, but it's basically an inside bar, and it's a small bar. And you consider the context, remember, bull channel, trendline break. The market's trying to convert into a trading range here. Ideally, the bears would have had a major trend reversal, which would have been, here's the bull trend line. The bears break the trend line with momentum. That's good. They're hoping for a retest, and then a sell setup, and then maybe a measured move. Here's the neckline of the double top. We get a higher high, double top, major trend reversal, and fall for some sort of measured move down here. One of the problems for the bears is the momentum back up to test the trend's extreme. Too much buying pressure. It's too steep, and not enough bear bars, not enough selling pressure. Because of the overall context, what's most likely here is the market's either in a trading range or a bull trend. This is clearly not a bear trend, at least not yet. And then you can see the sell setup failed. We're going higher. But look at this rally. And I just want to see if we can see up to yesterday, and by yesterday I mean Tuesday. There we go. Just look at this rally. Isn't it possible that it's 1 pullback, 2 pullback, 3 pushes up? And so this is a parabolic wedge. And remember what I mentioned on the weekly chart. It's not that I'm expecting a major reversal here, but the market is becoming climactic and getting far from the average price rather quickly. And overall, big leg down, a leg up, big down, big up, big confusion. We're trying to get a breakout of the trading range, and that's great for the bulls, but it's not the strongest looking breakout, and the bulls still need to do more. And at this point, I said it's a parabolic wedge. So for the bulls, parabolic wedges produce minor reversals. What does that mean? Well, parabolic wedges are breakouts on higher time frames. So just like this is the daily chart, we see the parabolic wedge, 1, 2, 3 pushes up. On the weekly chart, it's just consecutive bull trend bars. It's a breakout. On the monthly chart, it's just a trend bar or a couple of trend bars. And so one of the problems here for the bulls, it's 3 pushes up. So at the very least, you're expecting some sort of correction, some sort of pullback. And so my thoughts coming into the day was we had a bull breakout, but possible 3 legs up, maybe late in a bull trend, and then a fairly weak inside bar. Also keep in mind, what is this small inside bar, or almost inside bar, what does the small follow through look like? If you remember what Tuesday looks like, it was a trading range day. And so it's a bull breakout and follow through with another bull bar closing near its high, but when you crack open the follow through bar, it's actually a trading range bar. So my concern was that there were sellers above the follow through bar. And this is what I wasn't sure if I mentioned or not, but I was suspecting that we had an increased chance of an outside down day because of everything I'm saying. So we trigger the buy above the follow through bar. We go up above it, and then it was a small bar and a trading range bar, even though it doesn't look like a trading range bar on this chart. So we trigger above it, we fail to break out, and we're expecting a deeper pullback, and we go down. But when I say outside down, all I'm really expecting is for the market to close below the open. So I'm not necessarily expecting an outside down bar like April 4th here. Big outside bar closing on its low, huge body. Not exactly the same context, but this is basically what I was expecting. And with that, we will look at the 5-minute chart. Let me just draw yesterday's high. Thought that was an important price. And yesterday's low. And again, when I say yesterday, I'm referring to the prior trading day. So here's the high. Actually, bar 81 was the high. And the low. Bar 21. So bar 1, we gapped up to open the day. And then bar 1 was a big bear trend bar. So the market is rejecting the gap up. Ideally, for the bulls, we'd have a gap up and then a bull bar. That would be the market accepting the gap. It's almost like a breakout follow through. In this case, it's like a bull breakout and then a reversal, a failure. So bear bar, bar 1, but possibly support yesterday's high. You have bears who sold above the prior day's high. They got trapped on the gap up. Maybe bar 1's a vacuum test, testing the high where the bears got trapped. Maybe we bounce there, get a second leg up. But for the bulls, remember it's a gap up. You can see it as a breakout. And then bar 1 rejected the gap. So probably sellers above bar 1, maybe at the midpoint as well. The odds that bar 1 remains the high of the day is about 20% in general. But because of the context and what I mentioned coming into the day with the expectations, maybe it's slightly higher, maybe 30% chance it remains the high, but we need more information. And then bar 2 was a bull trend bar. It's an inside bar, and so inside bars, it's a triangle on a smaller time frame. So even though it's a bull trend bar, it's really a trading range. The first 2 bars are overlapping each other. Big down, big up, big confusion. Bar 2 is a high 1 signal bar, but after a fairly weak breakout, the gap wasn't all that far above the trading range, and then we came immediately down on bar 1. I suspect bulls are disappointed, assuming if we think theoretically, bull breakout, the gap up, bulls buy the open of the day, which would be like buying the close of the breakout bar. They're disappointed with bar 1. There's probably more sellers at the open and above bar 1. Bar 3, a little bit of a surprise. It's a big bull trend bar, consecutive bull bars. Are we always in long? We're probably always in long. But I have two concerns with being always in long here. Now, we might be always in long, consecutive bull bars, one being big, both closing on their highs. That's good for the bulls. But as far as the context goes, bar 3 is really the first breakout bar. You look to the left, bar 2 wasn't breaking out of anything. You can argue it's breaking out of the close of bar 1, but it's still within the range of bar 1. So that's an inside bar, trading range bar. So it's almost like bar 3 is the first breakout bar, and they still need follow through. Plus, there were probably sellers above bar 1, scaling in higher, and any breakout on the open has a 50% probability of reversing, no matter how strong it is. Follow through on bar 4, but basically bare minimum follow through for the bulls. It's a small bar. Strong enough up, you should expect the bulls should get a second leg, and bar 4 is a weak sell setup, so probably more buyers below, scaling in lower, looking for a second leg. We have an open gap. Bears are sold above bar 1. They're trapped on bar 3. They're looking for any bounce to exit their shorts. Bar 5, a bear bar, triggering below bar 4, the low 1, but we're expecting buyers below and more to the upside. What about buying above bar 5? I think if you're buying above bar 5, you're buying late in a rally. It might be one push up to bar 78, pull back, another push up on the gap, pull back, and then a third push. It might be 3 pushes up. Now it's a parabolic wedge, and so the pullback is expected to be minor, but there is a pullback to be expected. So I think buying up here is rather high. Plus you're buying above a bear bar. It's a high 1 with a bear signal bar. The odds are there are more sellers above bar 5. And then 6, reversing down fairly quickly. Actually a tick gap. So from the open of bar 6, the close of bar 5 to the open of bar 6, we have a tick gap. Everybody, when they saw the close of bar 5, just hit immediately sell the market. And the market gapped down a tick into the open of the next bar here. So consecutive bear bars, 3-bar micro channel, and especially worse, high 1 here. It's a deeper pullback, consecutive bear bars. Certainly expect more sellers above bar 6, but strong enough up for the bulls, you're expecting a second leg. And then an inside bar, bar 7. So trading range bar, inside bars have lower probabilities for breakouts, so probably more sellers above and buyers below. This sell-off, it's a 4-bar micro channel now. You're expecting a second leg down for the bears now. So the bulls hoping we have a bull breakout, fairly deep pullback, testing the breakout gap. By the way, it's actually still open. You'll notice the bodies of the bear bars do not yet overlap, and that's an indication that the line chart still shows a gap. The line chart plots the close of the bars. Anyway, the bulls hoping breakout, deep pullback, maybe a minor rally, another pullback, and then we rally to a new high. The bears hoping this was a buy vacuum test of resistance, and 50% of breakouts on the open fail. This is an opening reversal. Bar 1's a fairly strong bear bar. And because of the character of the market so far, the most likely event for the type of day today is a trading range day. Most bull trend days don't have big bear bars like bar 1 and bar 6. So with bar 7, probably sellers above. and then bar 8 just turned down. Bar 8, a really strong bear trend bar, but at the bottom of a trading range. Big up, big down, big confusion, 2 legs down. Now you can argue it's 1 leg down, there's no spike break, no bar. In other words, it's a micro channel down from bar 4 to bar 8. That increases the chances the bears will get a second leg down. And what about the bulls? Well, if a bull bought below bar 4, they are obviously disappointed and they're trapped. So we have trapped traders above. Bears who sold above bar 1 are relieved, and the market's overall in a trading range. Now, one more thing, what I mentioned coming into the day. There's one more concern for the bulls who bought up here, and that is if this is going to be an outside down day. We had a trading range the prior day, a weak bull breakout attempt. One actual breakout bar. You can say the gap up broke out, but then had no follow through. This is an inside bar. Then we had a breakout here, but weak follow through, and then turned down fairly sharply. So it's mostly a trading range, at least so far. And that's not ideal for the bulls, hoping we'd get a breakout of the trading range yesterday and then a measured move up. So we're probably going to test lower into the range of yesterday. And because it was a smaller day, that's why there's an increased chance we go outside down. So what do you do with bar 8? It's hard to short because you're low in this range. But if it is going to be an outside day, and that's your premise, it's okay to be short. There's enough momentum to the downside. If you use a wide stop, you can scale it higher. You're probably going to make money. This should get a second leg down. And then bar 9, we're crashing through the moving average and below yesterday's high, this red line. The market closed below the high, just barely, maybe a couple ticks. There's a big tail on the close of bar 9. If this is such a strong bear breakout, why is there so much buying into the close of the breakout bar? That's a little bit suspicious. The market might look to pull back here. It's hard to argue this is 2 legs. Down to bar 6, pause, down to bar 9, because there's just so much momentum. And the pause, it was just a doji. It's a pause bar, so not much buying pressure. So how many bull bars have we had since bar 4? Well, this is a doji, so really none. There's no buying pressure. So it's probably always in short and probably going lower. But whenever the market's more sideways in a trading range, that's where always in gets you in trouble. So what do you do here? I suspect it is still a micro channel, so probably sellers above bar 9, scaling in higher, looking for a second leg down. Inside bar, bar 10. It's an implied low 1 short. We sold off down to bar 9, rallied into the close and pulled back, and we're selling off again on bar 10. Some traders will take the sell, knowing it's a little bit of a low probability trade, because low ones typically pull back further. And the logic behind that, let me see if I can find an example from the prior day. There's a good one on the open. Strong bull bar, so bull bar 81, gap up, bar 1, really strong bull bar. So the market's rallying, and then we pull back. We get a high 1, technically triggered on bar 5. The signal bar was bar 4. But let's just say, here's your high 1. Let's look at it in real time. If you're a bull and you bought the close of bar 1, you're fairly disappointed with this. And then it pulls back, you're fairly disappointed. If it comes back to your entry price, what are you going to do? You'll probably look to exit. And that's without even realizing the context. This is a bad place to be looking to buy a high 1. Even if that wasn't the case and you're just looking at these bars, if you bought bar 1, you went sideways for 3 bars and then went down. And that's the logic behind selling high 1s and then looking for a deeper pullback. Today's a little bit different, the example I'm talking about. And that's because the disappointment is more minor. It's intra-bar. It's shown by the tails, so sold off on 9, pulled back, testing back down. But the same logic applies. If you look on a smaller time frame chart, that same exact thing that happened here, basically, is happening here. And so my concern with bar 10 is there might be more buyers below bar 10, and then the sellers are looking for a deeper pullback to sell. Probably sellers above bar 10, sellers above bar 9, looking for a second leg down. And then 11, you can see we rallied above bar 10, found sellers above, and pulled back. Now on this chart, bar 11 is the technical low 1 signal bar. But do you really want to sell a low 1 after it's been big up, big down, and then this is your low 1 signal bar? Of course not. It's a bull bar. Technically, it closed below its midpoint, so it's a sell reversal bar, but it's got a bull body. The context is bad, so probably more sellers above the bar and buyers below the bar. And then 12 rallied. So what's the problem with bar 12? It's a strong looking bar. Consecutive bull bars. Are we always in long? One problem I have with bar 12 is that it's 2 legs up. And again, it's implied because you have the tail of bar 11. So we rallied all the way up here on bar 11, pulled back, and now we're getting a second leg on bar 12. It's the exact same logic as down here. This one, it's the bull case. So if you can imagine this one, imagine it just like this. We rally, we pull back. Bulls who bought here are disappointed. They're going to look to sell on the retest. We rallied on 11, pulled back. So think about it. At some point, bar 10 or bar 11 was a bull bar closing at the high. And some unlucky bull bought that bar, or bought that price, bought here, only for the bar to sell off and close down here. What are they going to do on a retest like bar 12? You add with that the breakout gap. Bulls bought below a bull bar, bar 2, and the market just crashed straight through it. What's a bull going to do if they bought here and scaled it lower? That's what bar 11's testing, and they're going to exit. And we're testing it a second time. What do you expect? Probably more sellers. And even if we do rally a little higher, probably more sellers above. But this might have been strong enough as one leg on this time frame that it gets its own second leg. So we went a little higher on bar 13, but it could be seen as 3 pushes up. And again, that's implied. It's seen in the tails. Up on 11, pull back, up on 12, pull back, up on 13. So 3 pushes up and look to the left. Big sell-off, maybe a 60% correction. Expecting a second leg down. But strong enough rally. Up to 13, you're expecting a minor second leg up for the bulls. And I say minor, so even though there are probably more buyers below 13, I wouldn't recommend buying below 13 because the more major breakout is this bear leg here. It's better to look to enter on the pullback of the bear breakout, look to sell somewhere up here, and look for that second leg down, rather than you have this bull breakout, try to look for a pullback to buy below, and look for a second leg. Even though that's probably going to happen, you're more likely to get trapped buying here, and less likely to get trapped selling. But it is a trading range, and where's the high of the trading range? Could be all the way up here. And that's what's happening on bar 14. We're triggering the low 1, which was a low probability trade. You're selling a weak signal bar after 3 bars up. So buyers below probably get a minor second leg. But 14 is a high 1 buy setup in the middle of a trading range. After a big bear breakout, which hasn't had a second leg yet. Now in trading ranges, breakouts, it's common for breakouts to have deep pullbacks and for the second legs to be delayed. And that's what's happening here. We're getting a pretty deep pullback. We could even go deeper before we get a second leg. So as far as buying above 14, I think it's unwise. Probably just a minor second leg up for the bulls. We're vacuuming up to resistance where bears are selling. Maybe this breakout point, the bar 6 low, that's still open. Maybe we have to test there. But I do think the upside is limited. 15, it's a high 1 signal. On a lower time frame, it's a high 2. We've had 2 legs down. So we rallied up to 14, rallied up to 13, pulled back, rallied, pulled back a second time, and we're rallying again. but we have a bear close on bar 15. It's a weak buy signal bar, probably more sellers above. Even if we rally above it, if you sell above 15, you're probably going to make money. And then 16, it did not quite get above 15, but the logic is still there. You had traders trying to sell above 15, and at some point their limit orders were not getting filled. And you can see it's testing the high of the bar. It's testing one tick within their sell limit orders. And at some point there's going to be a sense of urgency for those bears trying to get short. And it operates the same way for the bulls. Bulls, maybe they're trying to exit above the high one, and they're not getting triggered. And at some point, everybody starts to sell. And we sell off on 16. Is 16 a wedge bull flag? We rallied up to 14, pulled back, 1, 2, 3. I mean, technically you can view it that way, but this is more minor. So you could say this is a strong enough leg. This is still the pullback. We should get a second leg. And that could be true. But with this big breakout, I think it's rather dangerous. And we have an inside bull bar on 17. It's an inside bar, so reduces the probability for breakouts, probably sellers above and buyers below. It's a high one on a higher time frame chart. If you just look at maybe the 10 minute, maybe the 15 minute, maybe we can see it here. And I typically don't actually like to look at the 15 because I don't watch the market live currently. So when I do these end of day reviews, I see the overall day briefly at the beginning, but this is like my first time going through bar by bar. So it's sort of a challenge and more authentic that way. So just use your imagination here and ignore this for now. Big sell-off and then fairly big rally, pulling back maybe more than 50%. And now we're getting, here's a rally, here's a pullback, and then another rally. On some time frame, this rally is getting a high one set up by signal bar. And that might be triggering above bar 17. But 17, we can see it's an inside bar, and we can see the context is bad. Why is the context bad? Because when you're buying a high one, there's really only, you can argue two, but I would say, maybe one or two places or context where buying a high one is the reasonable thing to do. And this is not one of them. One place is when you're in the beginning of a market cycle reset, you're in a leg one breakout, you're getting a high one early in a strong breakout, that you can buy. The other time you can buy a high one is when you're in the bottom of a trading range. Now, is this the bottom of a trading range? You could argue it is, but you also have to think about what the market is showing you, the information we have. We have this big bear breakout, and this is not a sufficient second leg. The odds are the market's going to go lower and at least test the low close of bar 10. So at this point, probably more sellers above the high one. And I call it a high one. Even on this chart, it's actually technically the high one because this is a micro channel. Is it a strong micro channel? It's really not. 3 of the 5 bars are, well, let's think of it this way. 3 of the bars close above their midpoint. And this is a doji. We've had one good bar for the bears in the past 5 bars. Actually, the past 7 or 8 bars. So we might have to get a second leg up for the bulls. 1, pull back, 2, and then get a second leg down. And why is that? It's the same thing the opposite way. Big bear breakout, deep pullback, and selling below 14, or selling below 15, selling below 13 was a low one. And if you're selling a low one, you're selling low in a trading range after a fairly deep pullback. It's the same logic I just said for the bull case. The only time you want to sell a low one is if you're high in a trading range or early in the market cycle. And this is neither of those cases. And that's why there's buyers below. And that's why, well, then there's also the fact that we had this sell-off. You had traders selling the close of 10, trapped on this rally. Any bounce, they're going to look to exit. There's disappointed bears down here. They scale in higher, they exit maybe at average price, we rally for a second leg. So we might go a little higher, but the fact that 17 is an inside bar does not help the bull case. 18, it's a strong bull trend bar, but it's a little deceiving. Is the market always in long? No, it's really not. But isn't it consecutive bull bars, one closing on its high and being big? Yes, it is. That's true, but there's a couple problems. The first thing, let's look at the moving average. Moving average is flat, and we have bars above, below, below. Market's clearly in a trading range. And where are we in the trading range? Well, we sold off to here, we rallied to here, sold off again, rallying again. We might be getting high in the range. And what's Al's number one rule, especially for trading range? Buy low, sell high, and scalp. So if we're going high, why do you want to buy? It's deceiving because it looks like a strong bull breakout, but bar 17 is not a breakout bar. Inside bars are the only non-breakout bars. Bar 17 did not break out below or above the prior bar. So it's an inside bar, a non-breakout bar. 18 is a breakout bar, broke out above several bars to the right or to the left. But you're still within the range of bar 13. So it's still a lower high. And it could easily be a second leg trap, 1, pullback, 2. And it could easily be a buy vacuum of resistance in a trading range. Now we could rally a little higher. I had the bar 6 low drawn earlier. That's a breakout point that we might test and then turn down below. But don't lose sight of the, you can call it the higher time frame context. Even on this chart, it's fairly clear to see what's a stronger breakout. Is this stronger than this? Of course not. This is probably a pullback. It's a two-legged pullback within a bigger breakout to the downside. So if anything, traders are probably selling bar 18 and scaling in higher. And it's similar to bar 3 as well, following an inside bar. So bar 18 is the actual legitimate breakout bar, and it still needs follow-through. And how's that for follow-through? And you have to ask yourself, if you're a bull, you bought bar 18, and that's your follow-through bar, you're fairly disappointed, aren't you? You can see also where we tested the bar 6 low, breakout point. So if a bull bought below the low of 6, scaling in lower, they got run over here all the way down, and when we retested it, we're finding sellers around that price. So what about selling below bar 19? Some traders will. They'll call it a big low 2. So sell off, low 1 below 13, deeper pullback, low 2 below 19. But you're selling against two strong bull bars, and those will probably get their own second leg. The second leg is expected to be minor. It could be as small as 1 bar, or even the tail on 1 bar. And the fact that 19 is a doji, it's just not an ideal stop order entry. But if I had to choose to sell or buy below bar 19, I'd look to sell, because it is a big low 2 short, and you're expecting a second leg down after this. I know I credit Al Brooks on this channel, and I talk about Al Brooks' methods, but there's another trader who Al Brooks was a mentor to. His name is Ali Moinaf Shari, and there's actually an article on Al's website that was published by Ali, and Al posted it, and I recommend you check that out. But the reason I'm bringing that up is there's something I learned from Ali that's really helpful that I want to share, and that is the market operates with event and response, and that's on every bar. An event can be a single bar, a response can be a single bar, or an event can be 100 bars, and the response can be 100 bars. Of course, everything's fractal. And the reason I'm bringing that up is because we're on bar 19, and we're wondering, do we want to look to buy? Do we want to look to sell? Was this breakout strong enough for more to the upside? Should I buy below it, expecting the low 1 to fail? And you can call it a low 2, really. It's a double top. But should I buy below it? It's a weak signal, strong breakout bar. Or is it a big low 2? The reason I bring up Ali is because I'm thinking of it this way. This breakout had a lot of bars. It was a micro channel all the way from bar 4 to bar 10. and it covered a big distance. So this is an event. And what are you expecting? This is a leg count reset. This is leg 1. And what do we expect with leg 1s? Leg 1s typically get leg 2s. And the probability of that is about 80%. And if you're careful with your chart reading and your filtering, that can get up to 90%. And it doesn't take that much of doing market studies to find that out for yourself. And I highly recommend doing that yourself as well, just to prove it to yourself. Leg 1 breakouts get second legs, like most of the time. And there's no higher probability setup or outcome in trading. So again, here's your event. We're expecting a response. What's the response? A second leg down. So what we have here is a bear breakout, a two-legged pullback, and we're expecting a response, a second leg down. And that's why I wouldn't look to buy here. 20, we're going higher. We did not trigger below 19. And that is enough of a second leg to me. I said 17 and 18, strong enough for a second leg. Then we got a pause bar, 19, and then another bull bar, 20. So for me, that's the nested 2 legs up. We had leg 1, pull back, leg 2, and then in here, leg 1, pause, leg 2. What's the significance? Why am I always talking about leg count? Well, remember what I just said. Leg 1 gets a second leg the majority of the time. And the more subsequent the leg count, the lower the probability is for another subsequent leg in the same direction. And that's why it's important to count legs, especially in trading ranges. I don't want to get too off topic in this end of day review. I'll just have to make maybe a leg counting video or something like that to get more into it. And please, if anyone, I really don't know if anyone watches these through, but if you were interested in that, just let me know in the comments and I'll get to it. But the reason I'm talking about leg count so much and why it's significant is leg 1, you're expecting a second leg. This is a leg 1 for the bulls, even though it's minor. This is a major leg 1. Here's a minor leg 1. You're still going to get a second leg. Here's your second leg. And then you have 1, pullback, or pause bar, 2. So it's a nested 2-legged pattern. So what's happening for the bulls? We're running out of buyers. Bulls who bought down here, they're looking to take profits. Bulls who bought here, disappointed, they're taking profits here. They're taking what they can get. Bulls who bought below 6, they got really disappointed. And now, look where we're testing. And maybe we're testing the low of bar 5. We're testing some breakout point to the left. And remember what I said in the beginning of the video with the line chart? If the bodies of the bull bars here do not overlap, so let me put it this way. If we don't get a bull close above the open of bar 5 or of bar 7, sorry about that. If a bull bar doesn't close above the open of bar 7, we will still have a gap on the line chart. And that's a representation of trapped bulls, and that's fuel for the bears to the downside. We don't even have to get there. This could be enough. Bulls finally get here, and they say, I'm out of here. We've had 2 legs up. And what's the significance of nested patterns? You have different computers viewing it different ways. The more traders see the same pattern, the more it's going to operate in that way. So you have 2 legs up. We're getting high in a trading range. And why is this the high of the trading range and not up here? Well, this still could be the high of the trading range. But this is the point where bulls got trapped, and you can see we're testing it. And look at the approach of the market up to it. It's taking a lot of bars. It's taking a lot of overlapping bars. It's taken 2 legs. It's not like we just rallied like this all the way up to here. So this is all information. And you have some computers saying it's 2 legs up to a breakout point, 2 legs up to a breakout point. More and more traders might be looking to sell here rather than buy. So with bar 20, even though we haven't had a decent bear bar since bar 16, I think it's fairly dangerous to be long here, probably high in a trading range. And with context, probably always in short. 21, an inside bar. It's a bull reversal bar, closing on its high, but just a one-tick body. And it's a famous high one. I talk about them all the time. It's a high one, but it's high in a trading range, and it's 2 legs up. So you have traders more looking to sell above bar 21 than buy. And I don't know how to put it. It's one of those trades that all the institutions see, for lack of better words. So they see bar 21 and everyone wants to sell above bar 21. And then when everyone wants to sell above bar 21, you might not have anyone else willing to take the opposite side of the trade, which means no one willing to buy above 21. It's similar to what happened here with 15 and 16. Sellers above, but it never triggered, and we sold off. The same could happen here. Or we could just maybe trap bulls 1 or 2 ticks above and then reverse down. But that is the expectation. And then look at 22. So we did trigger it, but that's the problem with high ones, and that's the context, and that's the overall event pullback. And this is a response of the event too. Big bear breakout, bulls trapped on the way down, bears trapped out. Maybe you didn't sell because we're above the moving average. Big bars, but going into a trading range. Traders want to sell a pullback. And so here's the pullback. Bulls are getting out, bears are getting in. And that's probably the turning point. I'd be surprised if we get above this price. That is the almost gold standard, like one of my favorite setups that I see. Selling above a high one in a context like this, high in a trading range, 2 legs up, trapped bulls, big bear breakout. There's a lot going for it. I'm actually surprised it triggered. So 22, outside down bar. I usually say outside bars are trading range bars, and they are. But what I normally say is buyers below and sellers above. Because if 22 is an outside bar, it's an expanding triangle on a lower time frame. And what that means is that if you're selling below 22, you're selling low in a trading range. And if you're buying above 22, you're buying high in a trading range. But when you think about the context and what I've been talking about, I would rather sell below bar 22 than buy below bar 22 because I think we're going lower. If we do go above 22, there's probably more sellers above. The bulls have a trend line, but it is a bull channel, and we know that bull channels are bear flags. And you can see 1, 2, 3 pushes up. So I was saying it's 2 legs up. Other computers see it as 3 pushes up. And you can see this in the Brooks trading course. It doesn't matter that the first push up occurred before the legs down were complete. All that matters is you see 3 trending highs. And we have a high, a higher high, and a higher high. And what's happening at each one, the bulls cannot close above them. We're finding sellers above. We're finding sellers above. They actually did close above here. Actually, did they? 69 and a quarter, 69 and a quarter. So bar 20 closed above the high of this bar, but not above the doji before it. So here, some traders, they wait for the sell signal bar 22 rather than selling below a bull bar, but big breakout, maybe a wedge bear flag, maybe you sell below 22 and look for a swing down. You still need a wide stop, and it's still a trading range. We could come back and test above 22, but if we do, that's a skunk stop location. That's a better place to look to sell than look to buy. $23, we have a bear bar, but it closed above its midpoint. So we have a bear breakout 22 and follow through 23. It's minimum follow through. It's basically a doji bar closed above its midpoint, but the bar did close bearish. So when you think about the opposite side, if you're a bull, are you eagerly buying above bar 23? Of course not. If you bought below 21 and you're a bull, you're disappointed. You just got trapped on 22 and 23. If anything, you're looking to sell above 23. And the bears are as well. So probably sellers above, maybe sellers on the close. And that's what happened. 24, traders sold at close. We went lower. However, 24 is an inside bar, and we're testing a price to the left where bears got trapped. Bear breakout, bar 16, immediately reversed. So we're testing the close of 16. You can see we're testing it 2 times. We're bouncing. Micro double bottom, 24. But same problem as the prior bar. It's a weak buy setup. It's a micro channel since 22, so 3 bars down increases the chances there are sellers above. But because of the trapped bears here, we might bounce first. That's what happened. 25, we went outside up. So what about buying above bar 25? It's an outside bar. It's a strong-looking bull reversal bar. Well, there's a couple problems with it. 25, forcing traders to buy with stop orders in the middle of a trading range. Never ideal. Also, it's closing below the moving average. If it was stronger, it would have closed above the moving average and crossed it. Also, I mentioned this is a micro channel down. This is minor, but it is a leg 1. So this is a more major leg 1, maybe a complex pullback. This could be the start of a second leg down, but this is a leg 1 breakout. You're expecting a pullback and then a second leg down. Plus, 25 is an outside bar, and this is where I say outside bars are trading range bars, expanding triangles, probably sellers above and buyers below. In this case, would rather look to sell above and hold off on buying below because of the overall context. I have not forgotten about this breakout, and I'm still expecting a response, a second leg down. We do have breakout points to the left. So maybe a bull bought below bar 20, scaled in lower, trying to exit at break even. Maybe we test the bar 20 low. Maybe that's where we rally to. Maybe the 21 low if the bulls are lucky. But the point is, I think the upside is limited. Bar 26, we triggered the buy above 25, but of course, it was bad context. It was an outside bar. We're expecting sellers above, and that's what we got. So 26 became a low 1 sell setup. I said this was a leg 1. It is a minor leg 1. It might be the start of a big second leg, but this is an instance where the low 1 actually makes sense. And part of the reason for that, there's a couple reasons that contribute to it. There always are. One reason, you just had bulls get trapped on 26. So if you bought above 25, that's your entry bar. You might just give up on the trade. You have a stop below 25. You know your stops can probably get run. You just cut the loss there. Another reason is the context. We're expecting a bigger second leg down. Here's leg 1, pull back. Leg 2, I can't say it enough. It's just the way that price action and the markets are structured. Everything revolves around the market cycle. Everything is breakout, pullback, channel, market, and then trading range. And the cycle just repeats, and it's all breakout, pullback, second leg, and you just see it everywhere. And so I don't think I can mention it enough. So here, you can argue it's a low 1, low in a trading range, but based on my research, I am inclined to believe there's at least an 80% chance we're coming down to the close of bar 10. And that would be a minimum second leg. Leg 1, pullback, minimum leg 2. I still think, maybe I have a bias coming into the day with the higher time frame charts, what happened yesterday, what's happening today. But the bulls, there's an early bull trap. They got trapped. And then we rallied a couple legs. The bulls, they're giving up. We're selling again. We could easily fall below the low of yesterday, all the way down here. 27, we did not trigger the low 1. Now 27 is the low 1 signal bar. Instead, we triggered above 26. What happened? We had breakout for the bulls, leg 1, pullback, and then a second leg up. The second leg was very brief. It lasted one bar. It was really the tail of bar 27, and then 27 closed below its midpoint. So we have two reversals down on 26, rally, down on 27. On some time frame, maybe the 1 minute, you'd be able to see a wedge bear flag, bear breakout, leg one, pull back. It's very small. I'm talking about the tails. Maybe I'll just draw it. There are three pushes up. 1, 2, 3, and we're selling off. 27, it's a bull body, but it is a sell reversal bar. The bull's unable to get a close above the moving average in here. Overall context, expecting a big second leg. So 27, even though it's not the ideal low one sell signal bar, it's not a bar like 53 on Wednesday, or on Tuesday rather. But the context always trumps the signal bar. Brad put it this way before: you never know which time frame chart is going to have the lucky signal bar. In other words, context will always trump the signal bar. So when you understand what's happening here, you have bulls trapped up here. You still have bulls trapped here. The bodies, remember what I said about the bodies? The close of a bull bar here did not overlap the open of bar 5 here. And so what I'll show it this way. It's more clear. Here's our gap. There's also a gap from all the way up here. So you could argue the gap is this entire space. Bulls haven't gotten up there. And so this is trapped traders. And we rallied for a couple legs, but the rallies were weak. There's a lot of overlap, selling pressure, big bear breakout, expecting a second leg. At some point, there's going to be a give up bar, and it's happening again here. Bear breakout, we try to rally, we fail. We try to rally again, we fail. And so we're expecting a second leg from this, but still a second leg from this. And then 28 is your give up bar. 28, we are selling off quickly. It's a big breakout bar, closing below all the bars to the left. Even though 27 was a bad sell signal bar, 28 more than makes up for that. Whenever you have a weak signal bar, you need the entry bar to be strong to make up for it, and 28 does that. 28, now you can argue leg 1, leg 2, and leg 1, leg 2. But it's usually better to wait for stop orders, especially when you know there are trap traders above. I actually forgot to draw one thing. So let's just say here's the gap. I forgot to draw another gap, and that is here. So now we have two open gaps. Now, because of the structure of the day, if you just look at this day, you'd either call it a bear channel or you'd call it a trading range. Now, it's fair to call it a bear channel where you have a low, a lower low, and a lower low, and then a high, a lower high, maybe a lower high here. So the market is channeling to the downside. It's fairly broad, but we are going to the downside. We have open gaps above. So as far as buying, sure, you can argue it's two legs down, look for a buy setup, but that means look for a buy setup, and it's still fairly premature. Look at the reaction, or you could even say 28, here's an event, and that's going to get a response. 28 still needs follow through, so it's breaking out to a new low of the day, but it still needs a follow through bar. If it gets one, it might reset the leg count. This is a strong enough breakout with gaps above that this will probably get a second leg. But instead, 29 rallied all the way up to the bar 27 low. It almost reached there. We did test the bar 25 low. So if a bull bought here, they got trapped on 28, they have a chance to exit at break even on 29. For the bears, if a bear sold 28, they're disappointed with their entry bar, front running the breakout, they got trapped. But so this might have a minor reaction. Maybe we come back to the low of the bar and get a small second leg up. But I still suspect we're going lower because this breakout, markets like to do things in a symmetrical way. So if it's a leg 1, leg 2, using extremes, maybe here's the leg 2 measured move. So we still have quite a distance to go. And what about buying 29? Well, you can argue it's a double bottom. It's a lower low double bottom, 2 legs down. But where's the buying pressure? You have a decent bar here, 25, but that's 1 bar in almost 10 bars. And then you have a bull bar, signal bar here, but big tail above after a really strong bear bar. Not ideal. The bulls haven't had a close above the moving average in almost 10 bars as well. 30, a bear bar closing on its low. 30 is another example of a low 1 that I would not buy below. And the reason I say that is because of the same reason I set up here. This might be strong enough to reset the leg count. We're expecting more to the downside. This was a strong breakout. You know there are trapped bulls above. We have yet another gap. I'll draw another one. Remember, we're looking at bodies. So the close of bar 29 did not even come close to the open of the bull bars before it. So more and more open gaps, which means more and more trapped bulls. And when the bulls are getting trapped, that is basically the radar to tell you you shouldn't be looking to buy. If anything, look to sell or be flat. But for now, you never want to be the first bull to make money. And what's happening here is even limit order bulls are having a hard time making money. If you bought below 25, huge bear bar for your entry bar, you have 1 bar to avoid a loss. It's the same thing here. We actually didn't even, let's see. If you bought below bar 20, 27 came close but didn't quite get there. And it's 1 bar that came close. So the bulls are not making money right now. Tight bear channel, it's a breakout on a higher time frame. If anything, you should be looking to be flat or be short, but I would not be looking to buy. 30, we triggered the low 1, not the ideal entry bar, but it was a tick gap, so maybe a sense of urgency. We opened a tick below the close of 30 on 31, and as far as buying above bar 31, I would not. Because it's a micro channel, since bar 27, it's a tight bear channel, and it's a breakout on a higher time frame. We're expecting lower prices, even if we pull back first. 32, a pullback, but obviously a really weak entry bar for the bulls. And remember what I just said. So I would not buy above here because it's not a credible buy setup. You don't have enough buying pressure. You don't have a good signal bar. It's a trading range bar closing below its midpoint. And a bad stop order is a good limit order, and that's why traders sell above 31. 32, it's a second reversal down, or you could call it a second continuation down. Low 130, then low 232. And on this time frame, technically, bar 32 is the low 1 signal bar, but every double top is a low 2, and this is a micro double top, so I'm going to call it a low 2. Same idea as selling below 30. Since I wouldn't buy below here, I'm still expecting more to the downside, and there's not enough buying pressure. If anything, I think it's okay to sell here or stay short or be flat, but I would not look to buy below bar 32. There are arguments. Maybe it's 3 pushes down. Maybe it's low in a trading range. It's a low 2, low in a trading range with a doji signal bar. But it's the same problems I keep talking about, which is the lack of buying pressure and the open gaps. So if anything, you have bulls trapped, and eventually they're going to give up. 33, we have a bull breakout bar going above 32, but not closing above 32. And even though it's a bull bar, it's completely below the moving average and is a tight trading range, which might just be a bear flag. It's a bear channel. We're going sideways. The bulls are hoping, they might view it as a final flag. It's more of a channel. Final flag I reserve for trends, and we're looking at a channel here. And here's the bear channel, and I'll extend this one to the right. And what's happening? What happens in bear channels? Well, if you study Al Brooks, and the video course and the books, you know what happens in bear channels. Traders look to sell rallies. Big bear breakout. You know the worst case scenario for the bears at this point, most likely, is a trading range. If not a trading range, a bear trend. We've got a couple legs up, but whenever there's a rally, they sell. Another rally, they sell. Bull bar, they sell. Another rally, they sell. What's going to happen on 33? Is 33 the bar that is going to be the lucky one that doesn't find sellers in this bear channel? Of course not. The odds are there are sellers above or on the close of 33 because in bear channels, traders sell rallies. Tight trading range, sellers above. The moving average is above. There's sellers at the moving average. And we know that 80% of trend reversals fail. Look what's happening. This entire thing is a trend reversal attempt. We sell off, we have a bear trend. Reversal attempt failed, reversal attempt failed. Here, here, here. It's a pullback. We went above, sold off, going up again. And what can we expect? We would probably expect failure and continuation for the bears. 34, a strong bear trend bar. Probably sellers below and a credible stop order sell. Might be a low 2 in a bear trend or in a bear channel at the moving average. And maybe this is the channel line. And then look at bar 35. Vacuumed straight down to that line. All I did was draw a trend line up here, draw a parallel, put it at the bottom, and that's exactly where 35 went to. I actually forget what I just said. I think I called it a sell vacuum. If I didn't, that's what I'm going to say it is. So I say sell vacuum because it's a huge bar to support. You look to the left, might be the bottom of a trading range. If anything, this is a measuring gap, and it could be an exhaustion gap. We don't know at this point. Maybe it's leg 1. Now we have a leg 2, maybe a leg 2 trap in a trading range. Again, we don't know yet, but we do know we have open gaps above. We have little buying pressure and fairly strong bears. But the context, yesterday's range, is going to damage the bear case. So we're probably going to go lower. And again, the expectation for me today was outside down. So we're probably going to get to yesterday's low. But if we do get there, I suspect the downside will be limited from there. And we'll probably find buyers below the trading range yesterday. But enough momentum. 34 and 35 might have been a leg count reset. And so here's a new leg 1. We're expecting a second leg. And what do you do here? If you're buying here, you're buying to buy back shorts because you're at support, maybe low in the trading range and the channel line. But you're not buying to initiate a long because you still have trapped bulls above and it's too much momentum. It's like trying to catch a falling knife. Better to wait for a credible stop order to look to buy, and we don't have one yet. And then 36 continued down. Look at the tail on 36. Let me see if I can do this real quick. Might end up being the 2 bars. I just want to see the 50% pullback and see if that's where 36 went to. So here's 50%. Turn off the label. And you can see 36 rallied close to 50%. If you use just the bar, that's about where it went. And then we found sellers. Why did it rally to 50% and find sellers? 35 is a surprise bar. And when I say surprise, I think about, well, it depends on the surprise you mean, because there are expected low probability events and there are unexpected low probability events when the market actually does the lower probability thing. But there's also levels to that because this is a bear channel and you have trapped bulls. So getting a give up bar, I was kind of hinting toward it. I'm almost expecting a give up bar at some point. the bulls aren't doing enough, you have trapped bulls above, eventually they're going to give up. Here's the give up bar. So as surprising as bar 35 is, it's almost not that surprising. I think of it as sort of like a jump scare in a horror movie where, you know, it's a surprise, but sometimes you can just see it coming. And then, of course, so why do we have the 50% pullback? Well, that's what I was getting into. It's a surprise. So you have bears who didn't sell below 34, and then we got this huge bar. You have bulls who maybe they bought below here, expecting this to be the bottom, maybe 3 legs down, and they got trapped as well. So what are they doing? Bulls buy here, scale in lower. They look to exit at their average price. Bears, they missed the sell. They're looking to sell on any pullback, and 50% is the average price where bulls who got trapped scale in. They look to exit at break even on their entire trade, and that's where bears will look to sell. 50% is a very common pullback level, especially in channels and trading ranges. Trends, you don't get them as much because trends have urgency. So you have more shallow pullbacks, like 30% or even less. 36 consecutive bear bars. Are we always in short? I think we're always in short. I forgot to mention always in. In here with all the open gaps, I'm not sure we were ever always in long. I did mention always in long here, but dangerous. Always in short by here, but trading range by low, sell high. But if anything, more bearish and gaps above. So probably always in short all through here. And so this, I don't know, it's more of a, like I said, either a measuring gap or an exhaustion gap. So you might have profit takers, but it's not enough to buy the close, and it's still always in short. So consecutive bear bars closing on their lows, one big, really both fairly big. Still always in short and probably going lower, but most breakouts pull back. We're at the low of yesterday. That's a major support level. That's a key price. That's a price where bears will look to take profits. That's a price where bulls will look to buy. But if you're a bull, are you excited to buy this? Probably not. So you probably need more sideways price action before you look to buy. So we might not be done with the downside. And I mentioned this might have been a leg count reset, and this is just adding to it. So now here's a leg one. You can say we got I say in air quotes, low probability breakout of the wedge. But the reality is there were open gaps and not enough buying pressure. The context supported more to the downside. So here's a breakout. It's probably a leg one. So for me, I call it a measuring gap. And there's just one more measurement I want to see. Here's the measuring gap, measured move. So we might come down to here before we get support. 37, obviously going lower. So a big bear breakout. But the characteristic of the day, it was mostly sideways. And then we just doubled the range here in 4 bars. It's climactic. It's going below support. It's testing several measured moves. I have this one drawn, maybe the measuring gap. We're closing below it. That's good for the bears. But at some point, we talk about this all the time, you have to think about the trader's equation. So if you're a bear and you're selling the close of bar 37, your theoretical stop goes above 34. You're never going to let that stop get hit, but that's the correct stop. The stop goes beyond the breakout. You sell anywhere in here, that's your stop. So a 1-to-1 is down here. Are we going down here? I don't know. Is it 60%? I don't think so. So if it's not 60% that we're going for that measured move, you cannot sell the close of 37 with a stop in the correct place. Otherwise, you have a negative trader's equation. If you're going for 1-to-1, you need at least 60%. And I'm not sure that this is 60%. You can argue it is, but then look at 1 bar later. It's hesitating. It's not just plunging down. And that's a problem for the bears. So inside, not that it's a huge problem. I'll get to that. So inside bar 38, it's a bull bar, but it's profit taking. It's not bulls buying. Remember I said buying here is like trying to buy a falling knife. If anything, the bull bar comes from bears taking profits. We're at several magnets, profit targets, the higher time frame, 60-minute chart, moving average, measuring gap, measured move, probably a measured move of the first 2 bars of the breakout. That's here. So there's a couple of reasons traders are taking profits here. But this is a leg 1 breakout. Any pullback is expected to get a second leg. And I just mentioned 50% pullbacks. Maybe we get that. So let me draw that. 50. So maybe we pull back to here. We're also probably going to get back to the low of yesterday. I do suspect we'll close within that price. I thought today would be an outside day, but not closing below the prior day's low. I just thought it would close below the open. So what do you do with bar 38? There's probably sellers above. It's an inside bar, but as far as selling below it, I would not. It's basically a low 1, and this might be confusing. I want to see if I can explain this. I say that you can sell low 1s when you're early in the market cycle, and I'm calling this a leg 1, but it's almost like it's a minor leg 1 in a way, because you think about day structure, you think about what we've had today. This could be a second leg down, maybe a second leg trap, but it's probably not the low of the day. We're probably going lower. But if you're selling the close of 37 and you get 38, you're probably disappointed and you're going to look to buy back your short and try to sell higher. So that's why it's not ideal to be selling down here. 39, we're getting vacuumed up to some resistance, maybe the low of yesterday. That's where we're stalling. Here's the 50% pullback. This might have been strong enough for its own second leg, but it's minor, and it's more of a pullback than a reversal. Probably sellers above 39. And then 40, going a little higher, breaking out above 39, closing above. That's good for the bulls, but this breakout is bad context. Big down, then smaller up. The bars are not uniform in size. We have sellers into the close of the bars. That's an indication that the bulls are not eagerly buying into the close, and it's several legs up on a lower time frame. But enough up that the first reversal down should fail. So as far as selling below bar 40, I would not. And then 41, we went even higher. So this is a fairly disappointing breakout pullback. Here's the breakout, and then this is your pullback. If you sold 37, remember what I said? Stop up here, you sell down here, your measure moves all the way down here. And traders don't want to do that. The institutions aren't doing that. The institutions are taking profits down here, and then they're selling a pullback. And that's why we go higher, then we find sellers, and then we sell off again. Still, this is enough up. It's actually a 5-bar micro channel, but 3 consecutive bull bars and then a doji. The first reversal down should fail. There is an increased chance that we just sell off because of this breakout. This is more minor, similar to what I said over here. So I would not buy below 42, but if you do buy below 42, your expectation is a quick scalp. I might have said 42, I meant 41. 42, we're getting a failed breakout attempt to the downside, which was expected, bouncing at the low of yesterday. High 1 above 42, but bad context, probably sellers above. And then 43 is so common when there's probably sellers above a high 1 that they just sell the close. 43 sells off. Too much momentum to be looking to buy, probably going lower. 43 consecutive bear bars. We never went always in long, so yes, we are always in short. But this was a deep enough pullback and disappointing enough that bears will look to take profits at a new low, and some bulls will even start buying below this rally. So this is now a support area. Now we have 1 pullback, 2 legs down. This was strong enough for more to the downside, but we could get more increasing two-sided trading fairly soon. Probably sellers above 44, but probably going a little lower. 45, completely reversed 44. It's a strong bull bar, but the context is still bad. It's strong enough down you're expecting a retest, probably test the 44 close at a minimum. And 45, if you're buying 45, you're buying into an area where the bulls just got trapped. Bulls buy below 42, trapped on 43, 44, getting a retest. And what are the bulls going to do here? They're going to look to sell. And then 46, they sold at the low of yesterday once again. You can see this price is fairly important. We tried to break below it and failed. And then we tested at 42, tried to break below it, failed, retesting it at 46. Probably a little more to the downside, but selling 46 after seeing 45 is also not ideal. It's becoming more confusing and probably converting into a trading range. And then a bear bar 47, but it could easily be a sell vacuum test of support. Bears sold to close of 44, trapped on 45, disappointed. We come back to this level, they're going to look to buy. 48, it's hesitating, so as a bear, you're not excited to see this if you're short. 48 is not a credible buy setup, but it is 3 pushes down. So you will have some bulls buying above 48, some bears exiting above 48, but not the most credible stop order buy. And that's why we went outside down 49. Now 49 is an outside bar after 3 pushes down with increased buying pressure, having a hard time getting away from the low of yesterday. So this outside bar probably has more buyers below. If you're selling below 49, you're selling an outside bar, an expanding triangle, which means you're selling a low in a trading range, and you're selling a third leg down. And that's never the high probability thing to do, unless the market's in a small pullback trend, which it's not. 50, bear breakout, but immediately pulled back. We triggered the buy above 48. That makes 50 a high too, but no bull bar since 45, so not ideal for the bulls. But still, 3 pushes down. So probably more profit taking here and probably more sideways. And then 51, a little bit of a surprise. You have bears taking profits, you have bulls buying. 51 such a strong bar. Probably resets the market cycle. The leg count, probably a leg 1, and probably going at least a little higher, but it might pull back first. And if we do pull back, a common pullback area is 50%. Maybe we pull back to 50% and then rally more. 52, it's a disappointing breakout bar or follow-through bar after the breakout. There is a micro gap, so the high of 50 does not touch the low of 52, but both bars on either side of the bull bar have bare bodies, so it's not the strongest micro gap. The context also isn't great. It's really a trading range after a pretty big bear sell-off. Probably sellers above 52 and buyers below. Inside bar 53 reduces the probability, probably buyers below and sellers above. It's a high 1, but at resistance. And then 54, instead, we rallied with a shaved bull bar. It's a strong bar, and it is a surprise. It's the low probability event. We're closing beyond the 60-minute EMA, the 5-minute EMA, the low of yesterday. So we're breaking above a lot of resistance. And then more buying. 55 might be by the close, but it could also be 2 legs up, high in a trading range, probably sellers above 41. But it's the opposite of catching a falling knife on the other side. Do you really want to sell against 2 consecutive bull bars? Probably not. 56, minimum follow through. So the bulls, we have the breakout above 41, minimum follow through, but not going very far. Market's overall sideways and probably going to continue sideways. As strong as this breakout looks, it's the context that's the problem. Just look to the left. 57, we fell below 56, but this was a low probability low 1. There were probably buyers below, and we should get a second leg up after 54 and 55. 57 is a high 1, but a bear bar. Probably sellers above. 58, we triggered the high 1 above 57, but sold off and closed within the bar. So disappointing for the bulls and it might be high in a trading range, but enough momentum up here, this all could be one leg, and we should get a second leg up. But the pullback could be very deep because it's a trading range. Outside up 59 is a bull reversal bar, but the context is still really not great for the bulls. Even though we're creeping higher and higher, you have a buy climax and then a pullback, a buy climax and then a pullback, trying to rally again. But look at the past 4 bars overlapping. This is a tight trading range within an overall trading range, probably sellers above. 60, we're getting another bull reversal bar, but the overlap is the problem. Look at bar 60 relative to the other bars. It overlaps the other bars by about 80%. This is channel behavior. So if you can imagine it on a lower time frame, it's a spike in channel bull trend. Spike, 54, 55, pullback, and then a channel, maybe 3 legs up. Most probable outcome, you get a spike, channel, and then conversion into a trading range, which means a test down here, the 57 low. So lower probability of an upside breakout, higher probability we come back and test 57. Bear bar 61, we tried to break out and failed. Bear bar closing on its low, bulls will exit below it, bears will short, but the downside is probably limited because this is a lot of damage by the bulls, and it's still probably going to get a second leg up. 62, we completed the market cycle, spike, channel, trading range. Now we're sideways, consecutive bear bars, but not closing below the moving average after a fairly strong rally. Now the rally's within a trading range, and we're high in the trading range. 62, probably more sellers above it. 63 is an inside bar, reduces the probability for breakouts, sellers above and buyers below. And remember, this is yesterday's low, probably an important support. 64, another inside bar, II pattern, so consecutive inside bars. The market's contracting. It's a triangle on a lower time frame. Easier seen on a lower time frame, but you can imagine it here. All that means is the range is contracting, getting smaller, and we're expecting a breakout fairly soon. 50% of breakouts of triangles are in the wrong direction, and then they reverse. Bear breakout attempt 65, but weak, closed within the triangle. Might try the other way now, but it is an overall trading range, so we're expecting breakouts to fail. We tried to go to the upside, failed, and then 66 became an outside down bar. But it's an outside bar within a trading range, and it might be 3 legs down. 57, 62, 66. Wedge, so 3 pushes down, maybe a bull flag, maybe a second leg up. Instead, we got the downside breakout, 67. And is that the lower probability event? Probably not. Think about the overall context. This might have been the high of a trading range. Maybe it was the high of 36. Here's resistance. Support is somewhere down here where we reversed. So over here, we're actually high in the range. We're trying to get a breakout again of yesterday's low, but now we're within this rally inside of a trading range. And you have trapped bears to the left. Bears sold above 50, betting it was a weak signal bar. Remember I said 51 was a little bit of a surprise after 5 bars without a bull bar down to 50 and then a weak buy signal bar. This bar becomes a magnet. Bad signal bars often get retested. So 67 bear breakout, probably going a little lower, but we're within a trading range, so expect disappointment. Like 68. 68 disappointing for the bears, but not enough to undo this. Probably sellers above. 69 testing the breakout point, one of the breakout points, which was the low of yesterday. We're testing it on 69 and probably sellers above. 70 a bear bar, low 1, but the downside is probably limited. You can argue this reset the leg count, but it was in a minor way. It's within a trading range. It should get a second leg, but this could be the second leg. Maybe we test a low close. Maybe we get down to the 50 high. But if we do, I suspect we'll find buyers there. 71, we vacuumed down to that price and then found buyers. So obviously, bears who sold here scaled in, betting we we would convert into a trading range rather than a bull trend. So they scale in higher. They exit at their original price, their entry price here on 71. This will reduce the number of sellers because of what happened, and that creates support. And look what happened on 72. The bears are taking profits there, and the bulls know that, so the bulls are buying there because it's 2 or 3 legs down at support. It's really interesting. 72, buy vacuum, huge bar, but overlapping lots of bars to the left and getting fairly high in the range, if not the middle, the high, so not ideal to be buying. Should get a second leg up, but should get a deep pullback as well. Remember, we're expecting disappointment and for breakouts to fail in trading ranges. And then we got follow through 73. The follow through bar overlapped the breakout bar by about 50%. And where did we test? We had the breakout point 69, maybe 70 high. So we broke out above it. Bears who sold here got trapped. They got out. And that's contributing to the buying on 73. So big enough breakout for a second leg, but getting high in the range where bulls just got trapped. So it might be resistance over here. And that's why we got a big bear bar 74. The market is going very sideways into the close. Obviously a trading range when you look at this chart. So buy low, sell high. 72 and 73 should get a second leg. Maybe 74 is the pullback. Maybe it's a deep pullback, 50%. Then we get another rally. The pullback can go all the way down here. But if we do go down here, I expect buyers below. 75, there were buyers on the close of 74. It's an inside bar, 75. Might go a little higher to test the 73 close where bulls who just bought got trapped. And if we do go there, they will exit disappointed. And we'll get a second leg up and then a reversal. And that's exactly what happened on 76. We tested the high close of 73 and then reversed down. Now we have a second reversal on 76. But it's basically a trading range bar, a doji signal bar, so not ideal. Might go a little lower, but if anything, we're in a tight trading range and expecting to go more sideways. And then we went outside up, 77. Might be a second leg up for the bulls, leg 1, leg 2, and we're getting high in the range, just where bulls got trapped before. So the upside is probably limited. And 78 reversed immediately. So you can see it as a second leg trap. Leg 1, leg 2, high in a trading range, everybody sells. But then 78, what do the bears do? They scalp out. They sell the close of 77, and then bears who got trapped selling below 76, they're getting out. And then there's buyers below 77, a strong bull bar. Probably going sideways into the close. Buyers below 78. 79 trying to break out, but it's a trading range, so breakouts are failing, and the breakout failed. Is 79 a good buy signal bar? Of course not. There's probably sellers above and buyers below. And then an inside bar on bar 80 reduces the probability for breakouts. The breakout will probably not go far, and there's just one more bar left in the day session. And then we tried to break out to the downside on 81, and we failed. And you can see we closed just a couple ticks below the low of yesterday. For always in today, I thought it might have been always in long on bar 3, but proceed with caution because of context. And then you get the bad follow through 4, and then you have to be thinking probably 50% of breakouts on the open fail. The context isn't great, and if there's any hesitation, I should get out. So with bar 5, might be a reason enough to exit along. And then it probably flipped to always in short on bar 7 or 8. Not 7, on 8 or 9. And then I don't think we ever flipped to always in long in here. So I think it's always in short, if anything. And then through here, I think by here, you expect buyers below. So at this point, if you're trading always in, it's still short, but you're taking profits down here. And then once you get a third leg down for always in short, not ideal. Probably better to look to buy low and sell high And after you get 3 legs down, the context makes this always in long. So even though it's a weak buy signal bar, it's not that crazy what happened. 51 probably flipped it to always in long, but then, it looks even more bullish here, but look to the left, high in a trading range. If the market's in a trading range, don't trade always in, trade buy low, sell high. So if it's always in long here, it's opposite, so time to look to sell. You can see the upside was limited. Big bear breakout, 67, but in a trading range, so always in is flipped. Probably look to buy low down here, and it's just in a trading range for the rest of the day. So always in, kind of all bets are off for that. Better to look to buy low, sell high, and scalp. For stop orders today, I thought it was reasonable to sell below 5. A little bit aggressive, but reasonable. And then probably okay to sell below bar 8 as well, a bear trend bar closing on its low with reasonable context. And then some traders might buy above bar 17. It's not ideal because it's an inside bar and it's looking for a minor second leg up. I think the better stop order trade in here is selling below 21. Even though the signal bar isn't ideal, the context is always what matters more. You can sell below 22 as well. And then I thought you could sell below 26 and 27 as well. 26 didn't trigger below. 27, same thing. Signal bar not ideal, but context was pretty good. 30, you can sell below. 32, you can sell below. Didn't trigger. 33, not as good, but remember we're selling rallies in bear channels. Then you get 34, you can sell below it. 35, bear surprise, you can sell below it. 36, you can sell. 37, you can sell the close, but then you get 38, disappointment. And then for stop orders after that, you will have some traders buying above 50. It's a second reversal. You can even say it's a third reversal. It's pretty important that the market traded above bar 45 and 44, and then above 48, and then again on 50. That makes it a high 3. So it's a nested high 3. Here's a high 1, high 2, high 3, and then high 1, high 2, high 3. And the context was good for a bounce. And then for stop orders after that, I thought 61 was reasonable. After spike in channel, high in a trading range, strong signal bar. And then that is probably it for stop orders today. Maybe you buy above. Actually, no, I was going to say 68, but it's too much selling pressure. You're going to get a second leg down after that. For limit orders today, probably sellers above bar 1, they're scaling in higher. Sellers above any of these bars, they didn't trigger until down here when it's not ideal. Sellers above bar 11. Sellers above 17, scaling in. Sellers above 13 over here. Sellers above 21, that triggered, right? The high is 69.25 and the high is 69.5. So sellers above 21. 24, it's a micro channel. It's a weak high 1. Good context to be looking to sell. So sellers above there. Sellers above 26. Bad high 1, bad stop orders or good limit orders. So sellers above 31. And then you might have sellers above 38. If you are selling, your stop has to be wide. And then to sell above 42 never triggered. Sellers above 44, but the downside is becoming limited. It's a lot of buying pressure here, and then you're finding buyers at the new low. So if you're selling above 44, it's for a scalp. Sellers above 48, it's a weak double bottom, unlikely to be the swing point. And you can see we went outside down. And there might have been sellers above 50, but the context didn't really support it. It's a nested wedge. And let me redraw yesterday's low. Nested wedge down to here. And we tried to break out and failed. Tried to break out, retested, tried to break out. That's 3 attempts. So not ideal when the breakout looks like this. Lots of overlapping bars. Bear breakout, but bad follow through, and within a big bull bar. Outside bar, bad follow through, not ideal. For limit orders after that, probably buyers below these bars, they never triggered. Up here, it became a channel, sellers above any of these bars. 57 was a bad high one, there's sellers above it. 58 is a bad sell setup. It's a second reversal, sell below 56, and then a second one below 58. But it's a tight channel and a bad sell signal bar. It's a bull bar. Buyers below, but these are scalps. Bad high one above 65, sellers above, strong enough down for a second leg. And then over here, even though it's a bull bar, I mentioned it's not a good stop order. So if it's not a good stop order, it's a reasonable limit order trade, again, for a scalp. And then again, it's 3 pushes down, so not ideal to be selling above 71. But if you did, scaled in higher, you would have been able to avoid a loss. Buyers below 73, strong enough up for a second leg, and a weak sell signal, bad stop order, good limit order. They're filled on 74. Over here, it's a double top above 76. Bad buy, you're high in a range, bad signal bar, sellers above. And it's a second leg trap, so a couple of reasons support that one. Everybody sold 78. And then buyers below, but really tight and not much left to do in the day. And as far as where do we go tomorrow? Well, like I said, it's a parabolic wedge on the daily chart. So I'm expecting a minor pullback. This could be the start of the pullback. Maybe we go a little lower, but because it's a bull parabolic wedge and then an outside bar, I suspect if we go below today's low, we'll find buyers below. There might be an increased chance of tomorrow being an inside day, maybe an IOI, because was it a bigger day actually? Give me just one moment here. I have a show me with the data tip. So if you look at plot 1 and plot 2, plot 1 is the bars range. This is the daily chart. Plot 2 is the body range. So 62 point day today, 20 the prior day, 70, 45, 44. It's about average, maybe a little on the bigger side. So that might increase the chances we have an inside day tomorrow. But tomorrow's Friday, and then that brings up the weekly chart. The bears want to close the bar below the midpoint. And does this look like a very strong bull breakout? I don't know. It's 2 legs up, and it's a bad signal bar here. And there's a fair amount of overlap. Tails into the close of the bars, not the greatest bull breakout, especially now. The bulls need to do more. And even if they do rally tomorrow and close the week on the high, it's a little bit deceiving because just zoom out on the 5-minute and look at the price action over the past couple of days. We did have a huge rally here, but after that, mostly sideways. And so what I'm expecting is more sideways tomorrow. As always, please feel free to leave comments in the questions, or leave questions in the comments, and include timestamps for any questions specific to this video. And I hope everybody has a good rest of their night. Thanks for watching.